Welcome to this February webcast. Our guest today is Steve Bittner of Liberty Mortgage Corporation. We're going to talk about refinancing, what things you should consider if you're thinking about refinancing your home, and what you should know if you decide to go through the process.
Right now, on a national average, on a conventional 30-year fixed mortgage, you're looking at roughly 5.5, possibly low fives. It is going to be dependent upon the borrower and their credit scores. FreddieMac.com every day posts a national average. Rates are great, and there's still a lot of lending being done. Where we're seeing some of the difficulties come in is with the appraised values on the homes. We haven't really hit bottom yet. Homes are still depreciating some, and credit scores have become vitally important. It used to be that if you had a 620 score, you can get the same rate that somebody would get at a 780. Now at a 740, which is an excellent score, below that you're starting to see some increase in fees and potentially an increase in your rate.
You emphasize that your current credit score is important. How do you go about finding your credit score?
More often than not, a lot of my clients come to me, we'll get an application, and I pull their credit report, and I'll provide them a copy of it. There's a number of websites that are out there, myfico.com, there's the annualcreditreport.com, which is the free report. I typically recommend people to go there just to get a feeling for what's in the report.
What are the pros and cons of refinancing right now? What should a person look at to determine whether it's good for them?
There's a lot of different aspects to take into account whether you should refinance or not. The first thing somebody always looks at, can I save some money? Everybody's trying to cut back a little bit. Saving some money is a great thing. It's not always going to be dependent upon the rate, though. There are so many other factors that are involved. Job security, if somebody's 401k has been wiped out, how long are they going to be in the home? If they're going to be moving out within the next several years, it may not make sense to do a refinance, even if they're going to save money in the short term. Again, people think they have to reduce their rate by a full point. Sometimes that's not the case. If you were to look at somebody who has a $400,000 mortgage going from 6% to 5%, they're going to save a little bit over $250 a month. If somebody has a $150,000 mortgage going from that 6% to 5%, it's going to save them about $98 a month. So there's a big difference there. Don't focus on the rate, focus on the goal. What is the ultimate savings going to be? Somebody might just be trying to reduce their monthly payment, which is more often than not the case. You also have people who got into a tremendous amount of debt, revolving debt, and we don't want people using their homes as ATMs and just cashing out and using those funds, but times are tough, and we know sometimes you have to make that step just to stay out of bankruptcy. If you have somebody who's self-employed, sometimes getting a small business loan is rather difficult. If you're self-employed and you want to buy a new piece of machinery or staff up for some upcoming business, you might need the funds that were only going to be available coming out of your home.
Now, walk us through the process of refinancing.
Right now it's tax season, and people are going through their financials and sort of getting an overall view of their financial picture. And a lot of them are vastly different than they were last year at this time. A home, more often than not, is going to be your largest financial asset. While you're going through your other documents, take a couple extra minutes, pull up your loan docs. What's your rate? Most people really don't remember what their actual rate is. What's your current loan balance? What do you think your home is worth? Figure out that. Get a referral. Somebody you know, whether it's a realtor, a parent, family member, a friend, has used somebody recently. Find somebody who's got a proven, competent mortgage professional. Sit down with them, figure out what the goals are, whether that's debt consolidation, reducing monthly payment.
Steve, let's say someone comes to you and they're torn between getting an adjustable rate loan and a fixed rate loan. Where do you take them?
A fixed rate loan, once you close that loan, is fixed for whatever that term is, whether it's a 20-year, 30-year, 15-year. It will not change during the entire time frame that you hold that note. An adjustable rate mortgage can be based anywhere from a year to 10 years, and everywhere in between 5 and 7. You will typically have a lower rate with an adjustable rate mortgage. Currently, though, short-term rates are the same level as long-term rates. They're simply not attractive. If you can take a 30-year fixed at 6% or a 5-year ARM at 6%, why would you take the 5-year ARM? Now, that will change. We're in a bit of an anomaly right now with the market. Long-term rates will eventually be higher than short-term rates, and then you simply need to do a little more analysis to figure out if a short-term rate is going to be your best interest.
Now, I know a lot of people watching are saying, wait a minute, those adjustable rate loans are what got us into trouble in the first place.
People will look at adjustable rate mortgages and interest-only mortgages as a bad thing. My view is it's no different than a credit card. The credit card didn't go into the store and charge these things up. If you hit your thumb with a hammer, it's not the hammer's fault. ARMs can be a great product. Interest-only loans can be a great product when used correctly. It's not to be used to qualify on a lower payment. You know that's going to go up eventually, and that's why a lot of people are going into foreclosure right now. There's a time and a place for everything, and those are good products when used appropriately.
Credit report, sometimes we have to update things.
When somebody starts to consider doing a refinance, more often than not, they're going to speak with a couple different providers. The good faith estimate is going to be the document that they're going to use to compare. And ideally, a good faith estimate should be a detailed written document outlining all the costs and fees that are associated with the loan, the rate, and when your current month or your final monthly payment. APR used to be sort of the benchmark where you could compare one lender to the other. Now that's sort of been a little bit of a gray area. So I always recommend, don't just look at the rate, look at all the numbers combined. And if you have difficulty deciphering them, I'm always happy to look at somebody else's deal and determine, hey, this is a good deal, I can't beat this, take it and run, or we can do better, let me explain how and why.
One lender's good faith estimate is going to be different from another lender's?
You will see a lot of differences in the documents that are out there. Some of them are very text-oriented. They tell you a lot, but they don't show you a lot of numbers. Other ones are all numbers, and you actually have to have somebody basically describe it to you.
There are a lot of people out there thinking, I should just refinance now. I've got a job and a regular income. I should take advantage of this.
Refinancing is a great idea. It may not be for everybody. There are times, and I've actually turned away quite a number of clients that there simply is not the savings there for them, or their home may have depreciated just dipped below the value that we needed for the refinance to make sense. Some clients are thinking about potentially moving in a couple of years. The main goal of the refinance is to save money monthly, but if you're going to be moving out of the home in a short period of time, you'll never see the savings for the additional funds that it actually cost you to do the refinance. So it's for a lot of people, but it is not for everybody.